Hello, everyone. Welcome to our roundtable. Today, we're going to be talking about current market conditions and some of the things that could impact your portfolio that you might want to be aware of. Today, I have with me our lead case design, James Egstrom, our portfolio analyst, Chris Krug, and our lead advisor, Crystal Ackley. Let's get started. A lot of things are going on in the marketplace, and many people are concerned. And you see a bunch of news, economic, some are good, some are not so good. There's inflation, there is a number of things. So we want to address some of those things and their impact on our clients' portfolios and how the confidence wealth philosophy that we built has impacted those portfolios and how many of our clients should be thinking about what's going on right now. Let's start with you, Crystal. Could you tell us a little bit about your thoughts on the subject?
Sure. So obviously there has been lots of headlines per se, right? And talking heads, this is usually when the time comes and we're going to hear a lot of things. And this is where you actually need to really step back and evaluate and make sure that do I have a good plan in place? And if I have a good plan in place that's already been tested and we ran all the stress testing on it, and we knew putting it in place that there will be some volatile times ahead. And if you are a holistic client of ours, then you know that this has already been tested. Your portfolio is supposed to stay in the same comfort zone that we all were comfortable with, you were comfortable with, and that there is no reason to jump ship, because this is usually what happens. You also have to be very careful about what's coming and what you're reading, because there's a lot of times agendas behind a lot of those articles that you read and what they want you to do and what they want you to purchase. So you have to really set the emotion out of it and remember again, did you have a good plan in place? Did you agree with the risk that we took at the time? And is your Monte Carlo simulations and all the scenarios we're running is still coming back successful? So I know James and I have been dealing with a lot of that Rem lately, just looking at rerunning numbers, looking at our clients' portfolios, their specific unique situation, and just making sure everyone is on the right track. And that's why we wanted to be really in front of you today. So you understand and, think of reason when you're, reading these things and, don't get emotional over it.
I think what we go after here, and to be clear about that, it is a top-down approach at Confidence Wealth. Ultimately, we want to hedge your risk. And I think in every single case we take in here, we make sure that the risk is lower to a point where we can mitigate some of the market conditions. No one can mitigate everything in the world, but there are definitely ways to make this a lot better. Chris, can you talk about some of the things that are out there in the marketplace that is out of concern to people? And maybe, James, you can talk about some of the things that we have done or we do to mitigate those.
Yeah, absolutely. Thanks, Rem. So there's really three different factors we're looking at this year. Number one is inflation. Obviously, everyone's been reading the inflation numbers lately. Number two is the potential impact of what the Fed might do this year, as far as are they going to raise interest rates 2, 3, 4 times? They're going to stop buying bonds out in the market. And then the stock market broadly, what is the stock market doing? Is the market up 20%? Is it down 20%? Obviously, that has a big impact on our portfolios. The challenge we have is if we start to try to change the portfolio significantly to try to account for some of the things that are happening, we risk deviating from our plan. And if we're wrong, we're going to pay the price. The other issue is that these three factors are all interconnected. So inflation impacts what the Fed does. If the Fed raises rates, that impacts equity markets. The inflation's impacting equity markets. So all these interconnected factors make it a lot harder to think about how we're going to change the portfolio to account for just one of those things. Like we can't just be worried about inflation, for instance. We have to take those other factors into account as well.
Thank you, Chris. Those are great topics and certainly the things that are on the top of our mind. And rising interest rate, inflation, certainly the big headline that I feel like I've heard the most about recently. And I know we've put some thoughts out there with some inflation hedge items, but I have to echo Crystal and what she said is that we put these plans together knowing that inflation will go up and down. We're going to go through market corrections, whether that's caused by COVID or a housing bubble or a .com bubble. Who knows what the next one will be, right? We just don't know. So that's why we put these plans in place to stress test them ahead of time, knowing that we're going to go through these different market events. And as we go through this, we're going to stress test it even further. So for instance, in some of our plans, we're increasing the inflation metrics to see how does the current plan withstand a higher inflation metric. The Monte Carlo that many of you have seen us run with you is already taking into account some randomized inflation throughout all the years that it's running in there. So we're definitely accounting for these things well ahead of time to make sure that no matter what types of events come, we're comfortable with the risk of our portfolio. And we know that we have a high probability of success of getting from point A to point B. Right. That's why we set goals. That's why we go through risk questionnaires and understand your circumstances as best that we can so that we don't necessarily have to worry when the headline comes up, says you need to sell everything and move to cash, or buy gold, or everything into Bitcoin. Right. Those are the headlines that we hear. And I can't tell you how many emails from different advisors out there, clients, prospects of various newsletters or headlines that we hear where it's almost the fear mongering where they're trying to create that sense of fear in you. But you really should focus on that plan, looking at what are the upside downside risks. Am I comfortable with that? And am I really on track to achieve the goals that I've set forth? How much income do I need in retirement? Do I need to buy a new home? Am I leaving so much to my kids and getting that estate plan in place? These are the things that are all planned for ahead of time. So that's where we come back to the plan. Do we need to make some minor adjustments? If we have new assets coming in, we might add some inflation adjustments in there, right? Some real estates are nice things. Commodities are already part of a lot of our portfolios, so we're planning ahead on those things. So again, I'm the brokered record on these roundtables because I always say to stick to the plan, but that's really what it's all about. We're going to have all of this noise coming in. If we can drown out that noise and really focus on our own circumstances and the plans that we've put together, we can hopefully avoid the stress that comes with all of the headlines that we hear out there.
And let me add something to James's your point, in a sense, that the news, it's not just bad news, it's good news as well. So good or bad, it really is the same. It's being in a place where you're in the middle, where you're not being affected by all the good news or the bad news. Lots of times you see people getting excited. Oh, it's good news. Market is up. As you said, James, gold is up. This is up. Okay. Well, these are all lots of times temporary. And at some point, if you just hold steady, you're going to be able to capture the gains and the good things out of these things. But at the end of the day, the other way is also matters. When things turn, you're going to also be in a good place. So the idea behind it is that whenever you're reactionary, whenever you go after something that is shiny, we always say the shiny object for the time being is when it ends up being a problem. The shiny object when it's good, and then the fear when it's going down. The plans we create are constantly being monitored and tweaked for the betterment of the client situation. So I think that's that balance that it provides is really what we hope would keep the client in the right place and keep them in good standing with their plan.
And Rem, I agree with you. One of the things that's really important is if you're listening to this, we keep saying if you have the solid and right plan in place, because that is the key. If you don't, and if let's say you're a friend of a client and you're listening to this, or maybe you're met with one of our advisors, but you haven't yet finished your planning sessions and so forth, that's different. Then I can definitely understand you would be a little bit afraid. You will be a little bit more fearful because you don't know, it's that unknown. But when you do have a good plan in place, that's the whole point about you don't time the market. It's your time in the market the right way. There has not been, if you look at, if there was someone or these talking heads, right, or these headlines, they knew exactly when to pull the trigger, when to get out and when to get in. First of all, we would probably most likely never hear about them because it would be a secret and they would not want anyone to know, or it would be out there and the price would be so high that you couldn't even afford to actually have that plan in place because it doesn't exist. And Chris, maybe you can talk a little bit about that because you read about these talking heads that do talk about get in and out and why when this happens, this is what you should do when this happens. And what has been your experience knowing and looking at these, charts day after day of what happens in the market?
Crystal, that's a great point. And there's really two aspects to timing the market. Sometimes it feels like, well, the market is trending down, I should get out. But the flip side is also true. You have to know when to get back in. And, the average person watching the news, it's kind of easy to feel like things are going bad. The market's down 15%, 20%. Maybe I should get out. Now, if you get out and you're in cash, you have to figure out when to get back in. So I actually went through and looked at 2020 when COVID first brought markets to a bit of a halt. If we assume on February 19th, you have $100,000, right? 8 days later, the market's down 12%. You've lost $12,000 in just a single week. And that's how fast it happened, right? So the market's down 10% before you've even started to think about making a change. You start thinking about getting out. You don't have a backup plan because you have a well thought out plan. So we don't have a backup plan because we're not planning to get out of the market. A few days later, it's back up a couple percentage. Another week, now you're down $73,000. So you've lost $27,000 already. Now you panic and you get out and you move to cash, you move to gold. Again, you don't have a backup plan, so you just panic and you move to cash, right? Now what do, right? 2 weeks later, you would have lost another $7,000. You're feeling pretty good about it, right? You're like, I made the right decision. Just 3 days later, the market's rebounded 17%. You now would have been back up to 78,000 when you got out at 73,000, right? But you've locked in $27,000 of losses. Now you're trying to figure out, what do I do? Do I get back in? And the market's volatile at this point. Some days it's up 3, some days it's down 3. So finally, the market stabilizes a few days later, you get back in. Typically, you would wait even longer than that, but I'll give you the benefit of the doubt. You got back in at a decent level. Now you end the year at $98,000. So when you get out late and you get back in late, you've compounded your losses. You've locked in the loss on the downside. You've missed the rebound on the upside. And it's really that flip side, that getting back into the market, that's really hard to do. It's easy to get out when everybody's panicking and pull that trigger, but knowing when to get back in is equally as important.
I totally agree. And one of the things I will still emphasize on a little bit is that we're not saying everything is going to be okay if you didn't have the right plan in place. Because if you are in the distribution phase of retirement, and let's just say you had your entire portfolio in the S&P 500 index fund and you let it ride. Well, we all know if you took that ride in 2000 at the beginning of your retirement, let's pretend that was retirement, we all know it wouldn't have been a good even the survival rate for most people by the end of 2015 and 16. So we're not by any means saying all crashes are okay and all ups and downs are going to be okay. It's about when you have a solid plan in place with the safety net, then you do not time the market. You don't worry about it because that's already been accounted for. I just want to make sure that, if you're listening to this, you understand that. So if we sat together, you sat with one of our advisors and that's already in place, you're in good shape. We don't have to worry about you. But if you haven't done that, not only are you going to go through this in 2022, but you may go through this God, I don't know how many more times during your retirement. And that's not how you want to really live your retirement, by headlines and news. I could imagine that could be very uncomfortable. And that's something, Rem, I would say that's been our philosophy here at Confidence Wealth for a very long time. Have a safety net in place.
I would say that comes back to risk tolerance very much as well. Knowing your risk tolerance and knowing the downside that you're comfortable with. Nobody's investing to lose money, right? That's not why we invest. But the markets are going to have ups and downs, and we have to be comfortable with some ups and downs if we're going to be invested in the market. If we want those 20% returns that we get in some of those years, we're going to have some of the years where we see some of the downside as well. But putting that in a way where we're comfortable with the potential for that downside is really the most important part, because that's going to keep you from making those knee-jerk reactions where maybe the markets are down 50%, but if we've limited that to 15, 20, and that's within your comfort zone, we're going to feel okay about that, right? So that initial plan and setting that up and really putting that in place for the long term is really going to have a significant impact even on your psyche as we go through some of these ups and downs.
The key to this is not having overexposure in any area that in the end could end up devastating you if the metric for that area goes the wrong way. nobody can guarantee anything in the world, but what you can have faith in is that the fact that a lot of the things that if they're balanced in the right way, if it goes off for a while, it'll balance itself in the longer term as you go back. And I think that's, again, some of the plans that have been designed for the clients is to avoid that overexposure in one area or the other. It's easy to overexpose, by the way. It's just really common. There is a reason for it. It's a lot of interest by a lot of companies and corporations in promoting their particular brand of whatever offering that they have. So if you're a company relying on equities, you're going to say, well, equities are great. It's always good. But and you're going to be fine, and they will probably be set at some statistic. The reality of it is that if you're not balanced and if your exposure isn't done correctly, you could end up with a big problem. That's how problems happen. If that is not the case, nobody would lose money. Nobody would have a problem in the marketplace because at some point it will balance out. The reason there are issues is because there's no balance. And I think that is the thing you can take comfort in, is that there's balance in the design of the portfolio at Confidence. The team works very, very hard at understanding you, understanding how you're thinking, what do you want, what are your objectives, and see if we could balance that out in a way that gives you lesser exposure as bad things happen, because bad things will always happen. We're not going to stop that in the world. So, Chris, any thoughts on that?
Yeah, Raymond, I think you hit the nail on the head. When you talk about overexposure or overconcentration, we always preach diversification. The other thing we talk about is matching your risk tolerance to the risk of the portfolio. So there's very few clients that the S&P 500 is the perfect reference point for, but that's the thing that the talking heads are always referencing, right? Is the S&P 500. If you have a 20% equity and an 80% bond portfolio with us, then only 20% of your portfolio is in equities. And so that S&P 500 that's down 10%, that's only down 2% for you, right? And plus whatever the bonds have done, the bonds is usually up a little when stocks are down. So just watching what the S&P does is really not healthy for the client that isn't 100% S&P. You have fear of missing out. You have S&P envy when the S&P is up 30 and you're only up 10. But when the S&P is down 30 and you're only down 10, then you feel a little bit better about it.
And by the way, if you think that this is a psychology that's only exclusive to you, it's not. Because when I say you, anybody who's listening to this, because even big corporations sometimes end up over sort of betting on things, and they end up with a problem, as it happened in the last crash when COVID started. There are many examples of corporations that actually lost tons and tons of money because they bet too heavily on the market. And even when COVID hit, they pulled out of the market, even at that point, even at their level of supposed expertise. They're institutional investors, and they end up losing significant chunks of money when the market picked up again by not doing that. So I think that goes to the conversation we're having, Chris, is that you never know. It's not simple to go out there and try to predict this. And there's always somebody want to tell you that you should be just pulling out and hanging in there. And in most cases, that those people are sort of taking a gamble. They're going to say it. If it works out, they say, see, I told you. If it doesn't work out, they disappear just as if nothing happened. And then guess who's left holding the bag would be necessarily the client.
That's a great point, Ram. And I can't tell you all too often. Everyone wants to talk about their winners, right? So when you're having conversations with friends, neighbors, family, you're not getting the whole picture usually, right? I can't tell you how some of my previous firms where you see the whole account, all they want to talk about is that one winner up at the very top. They don't want to talk about the 9 losers that they have down below, right? So just because somebody has one, magic bullet that they said was the greatest thing, they're not giving you the whole picture, right? And they also don't know your circumstances. They don't know if you have a plan in place and the other pieces that do work together like that. So all the noise out there, again, you kind of have to take it with a grain of salt, even if it's good information, right? Even if it's valid and it certainly fits that, it's still good to kind of trust but verify, right? And do your own research. And we're here as well, right? Questions, concerns, we're certainly here to help and make sure that you feel we're confident. Confidence Wealth Management. We want you to be confident in your plans for the long term. So we're here to help.
And the big thing here is that one of the things you're trying to do in this particular roundtable is give you an idea of what we are doing and what the markets in general are doing and how does that relate to you. It is important to always keep in mind that it is the balance, which is the crux and the foundation of the plans that you have. and you have it. If you're here with us and if you're doing something in here in terms of your planning with us and you've done it, then it's been over the years, over a number of events that happened historically in the recent 2 decades, we've seen that those plans held up very, very well. So this is not a new thing for us in here at Confidence. And we've done a lot of work in that area to make sure that we balance portfolios in a way that is relevant to your situation. So you can have that confidence. You can have that sense of safety in a sense that things will somehow eventually, even if things turn, that they'll be okay. Nobody in the world can guarantee anything, as I always say. And we always say that there's no guarantees. But we do know that if it's a solid plan, if it's balanced correctly, you should be able to weather storms like a ship that is sturdy and solid. It could get wet, but what you want to avoid is it being capsizing. You don't want a boat that is fast and going to get you somewhere, but is going to fizzle as soon as there's a little storm. You want something that's solid that can take you through.
Well, one of the things we always talk about is we're not here to give you an exciting roller coaster ride, right? We want to make the ride as boring as possible. And that's why you have to be really careful about those roller coaster hypes you do hear, kind of like what Chris talked about. I thought that was a very good point, and I don't want that to go missed, is that all the conversation is always about just the equity market, as if someone is 100% in the equity market. And realistically speaking, even when you look at Warren Buffett, you can't say every single thing they have is in equity market. Even the biggest, billionaires have diversification. They have real estate and they have other things. So that really plays into the fact that you have to be really careful of where you're getting your news, what they're saying, and truly what does it mean to you when it comes to your plan. And we keep saying we're back, like James said, a broken record of plan. But that's why a solid plan in place is one of the most important things you can do. Now, we also know, maybe this will be possibly a little bit of a bumpy ride in 2022, but that's why you got the seatbelt, right? That was your safety net. That's why you're okay. We know how the ride is going to look like. And the most important thing is also just knowing that things are not going to look exactly like they did, during the last 5-6 years. That's something, Chris, maybe we talked a little bit about that at our investment committee meeting. Is really the 60-40 fund or the 20-80 fund going to do what it's done the last 5, 6, 7 years in the same way? Probably not. And maybe you can emphasize a little bit on that so people are prepared and they understand how it's going to look a little different than it did the last few years.
Yeah, we've had a really strong run the last 3 years. Equities have been up double digits. If you've been in, if you've had a big position in something like technology stocks, they're up, 30-40%. Some really, really strong numbers. So even fixed income has seen some high returns over the last couple of years. Typically, we think about, projecting over the next 10 years, equities, something like the S&P 500 might return 6 or 7% per year. We've been doing, in some cases, 2 and 3 times that. So in theory, we're going to have years where the S&P 500 is going to be down 10% or flat or down 20%, right? That's the sort of that long run expectation. But we should enjoy the good years, right? We can't expect that every year is going to be these record-setting years. But when the market is down 10%, we should also not panic, because if we look back over the last 5 years, we've still done really well. If the Fed raises rates and your bond portfolio is, all of a sudden down 3 or 4% in the short term, over the last 5 years, you're still up, I'm going to make up a number, but, you're up 4 or 5% per year, which is, probably above the long run average. So, it's just simple. Like we always say, zoom out, right? Don't look at what it's done this week, this month, this quarter. If you have a plan, James talked about the Monte Carlo simulations. And, the great thing about Monte Carlo simulations is it's mathematical, but it's random. But there are hundreds and thousands and probably millions of different paths your portfolio could take over the next 30 years. And if we can run, 10,000 paths, we can sort of evaluate out of all those possibilities, are we still comfortable with this plan? And if we say yes, then whatever might happen this year is probably contained, or something similar to that is contained in those Monte Carlo simulations already. So we've already stress tested this portfolio. We've already shocked it with inflation. We've already looked at what if the market's down 20%. So we've already accepted the possibility that something like that could happen and still get you to where you need to be in the end.
Absolutely. And I would say start looking at things in a little bit in a more positive way. So example, there might be absolutely crashes ahead and maybe some of your favorites will hit a pretty low mark. Well, wouldn't that be a great time to pick up the phone and say, hey, I want to convert some of those shares to a Roth, because now that at a discount, I believe in them on the long term, but on the short term, let me take advantage of some Roth conversions. So that's why, again, a planning takes into aspect everything else, tax planning that goes with it as well. It's not just about the investments.
So let me say something here. I mean, it's probably worth our time to reiterate some of the core philosophy that we apply in terms of how we help our clients achieve a better result. So there's two things going on here. There is the growth in the portfolio, of course, through whether you're doing it through investment vehicles that we choose. And then there is the strategies that we use to help the client achieve growth through whether taxation strategies, whether it's estate planning strategies, things that could create a yield for the portfolio in the long term, of course. All these things, and Crystal, you just talked about Roth, for example. Roth conversion is only one of the strategies we use to sort of create some sort of an arbitrage in clients' results over a long period of time. Some of it is based on projections. Some of it is based on immediate things that we can take advantage of. But the implementation of advanced solutions and strategies in a client's portfolio is one of the key things that we do very well in here. And I would not say I'd say you guys do in here, because you're the front line doing the work in terms of finding out what is it in one's best interest as far as, say, just certain tax strategy or certain estate planning strategy or charitable strategy, or whether it's relating to their health financial planning or any other area in their life that could create a benefit in terms of growing their assets. It's a long game that confidence applies in the strategies that it uses, which is how can we mitigate the risk? Simultaneously, how we could make sure that the wealth or the assets that you have are maximized with accordance with the current laws and opportunities that are available in the economic environment that we're in.
Those are some great points. And I have to echo Crystal. I mean, market downturns or negative news can present opportunities for us, right? It's not all a negative thing. Trying to keep that positive attitude, I think, is fantastic advice. And, when these things happen, it's not all bad. There's opportunities to improve probabilities and such, especially since we've already done, as Chris had mentioned, the Monte Carlos and stress tested these things. So we're comfortable with the downside of the portfolio, and we may actually have an opportunity to add some value in those scenarios, whether it be Roth conversions or other tax strategies or looking at estate plans in certain ways. So there's never a time where we don't want to look at what strategies are able to help us maximize this. And sometimes the negative events are some of the best times to do these things. So there's always something we could try to think of, right? It might not always work, but we could always look at the scenario and see if it's going to fit.
And that's what I think is excitement in the work that you do, is that you're always looking for something. You're always looking for what could be an opportunity that we can take advantage of for the sake of the client. I mean, simple case in point. You see business owners, for example. If you're a business owner, there are strategies sometimes to protect your business from being sort of going wholesale if something is to happen to you and your heir losing on the entire value of what you built throughout a lifetime. That in many, many cases could be significant amount of money. It could be even in the millions of dollars in some instances, where people would lose because they haven't done the proper planning when it comes to structuring their financial situation so that they would not have those issues. There are a number of strategies we can implement to help a business owner, for example, protect that asset that they built over the years and not have, say, most of it go to taxes if something's to happen to them. Or if they're selling it, perhaps lower the tax basis on it. For people that have assets in a different way, not necessarily from business, there are a number of strategies, whether using charitable funds or certain kind of strategies that will help them with their taxes and give them what they want in terms of the philanthropy, but yet at the same time get those tax benefits that could help other part of their financial situation.
No, I think you're 100% correct. No matter what situation that whether you are a business owner, you're just a personal investor, right? However you have your assets, again, there are strategies you can employ. And again, it's not just the investments. It's just a small piece of the pie, really. When you look at all of the different places that we can look at where you can add value, we mentioned taxes and estate planning, but is there education planning that we need to do around this? Insurance planning, not just life insurance, but everything. Are you fully covered? Are there ways we can produce income in future years and boost that up in a certain situation? So there's so many different avenues that we can go to that it just should all be considered. And again, back to the point that negative news isn't necessarily a negative thing, right? There are opportunities, whether it's a business or personal. There's almost always something to at least consider and see if it makes sense in this specific year. And a lot of you have gone through some of the tax plannings with us, where we look at those different strategies on a year-over-year basis. And sometimes we're looking sooner than later based on what's going on in the market, right? So we're constantly in motion, right? We don't know what the future is going to hold, but we work with what we know and we try to plan around that with our best assumptions and thoughts that we can for the future. And again, that comes down to why we stress test these and why we run the Monte Carlos, because nobody knows the future. There is no, some of you have heard me say this before, there is no such thing as 100% in financial planning, right? If you're getting to even, the high 90s there, you're in a really good spot, because absolutely nobody knows the future. So we work with the now and what we know, and the strategies that we know will add some value for you.
I said, I get you there, James, in the most boring way possible, right?
Exactly. Right. We don't want all the ups and downs of all that, right? We want it to be kind of a steady way to get you from A to B, whatever B is, whatever those goals are.
And this is the thing that excites me about the firm on a daily basis, the sheer amount of strategies that the firm is always looking for higher and better than most, in my opinion, advisors out there do, which is just an investment piece of it. There are so many strategies. You look at it from tax-free strategies, as we said, to business strategies, to other types that are really have helped a lot of our clients in ways that are, I've seen it. It's pretty incredible as to how effective they can be for the right person.
You guys remember when we used to be able to do tax loss harvesting? Remember that strategy that we haven't been able to do for a long time because the market's been at all-time highs for several years, but I think that's a great example. People forget that, when there's a downturn, it's a good opportunity to harvest some losses. Even more importantly, a lot of clients are, pushing back against making any changes because of potential tax implications, right? So they think about, I don't want to sell this because I have to pay taxes on the gains. Well, sometimes when the market pulls back a little, you can take some losses, reevaluate, your holdings and get into those positions that you think are really well structured for the next few years, as opposed to just staying with what you've been in because of, the embedded gains.
It's always thinking outside the box, right? Because I remember having a meeting with someone who was very, very heavy in one stock, and they just wanted to diversify, but they were having a hard time diversifying because they were going to be selling at a very high. And all this time, they're also donating a good chunk every year to their church. So we came up with a solution, but wouldn't it be a lot better if we just took a lot of these stocks that you don't want and put it in the next few years in a donor advisory trust fund? That therefore is supplements, all these other years worth of donations that you were going to do. That immediately allowed them to diversify what they wanted, because now they had the cash on hand that they normally would give away, that they could invest in what they wanted to. And they were able to give a big chunk of what they were heavy into those donor advisory trust funds. So then they can diversify however way they want for that different charities that they're going to donate to. And it was those thinking outside the box that even I know their CPAs well, why didn't we think about this? And they were super excited when we got together and came up with this solution. And it was all about, it didn't matter what was going on at the time. There's always some sort of a solution we can address, whether the market is up on something that you're trying to diversify on, or the market is down on some of your favorites. And really the key, I would say, is take everything with a grain of salt when you're reading the news. When you're getting those headlines, that's the big thing. And remember, that's what you have us here for. If you want to brainstorm some things, if you're worried about something, sometimes it's okay. Just call your team, have a conversation. Don't go to sleep at night stressed for no reason. That's the whole point. We want you to be worry-free, knowing you have a good, solid plan in place. Now, for those of you who don't have a good, solid plan in place, then I'm going to tell you, yes, start thinking about that, because I can't tell you to sleep at night not worrying, because when you don't have a plan in place, you don't. And I don't want you to be making the wrong decisions. So that's why, again, getting a solid plan in place is the key.
So that's been very interesting. I like the conversation. It's great. It's really motivating as far as I'm concerned, as to see how the plans are and how we've done this. Any final words? Let's start with Chris.
I think the name of the game this year is going to be volatility. The Federal Reserve is going to hike interest rates some number of times, 2, 3, 4 times. They're going to be doing some other programs. The market's going to go up. The market's going to go down on a daily basis, on a weekly basis. As rates go higher, as inflation numbers come in, all those professional traders, the hedge funds, the asset managers, they're going to be reevaluating all of their investments. And that's going to drive prices up and down probably through all 12 months this year. So there's going to be good weeks, good months, good quarters. There's going to be down weeks, months, quarters. So don't get caught up in that daily headlines, right? We know when the market's up, market soars. That's the headline. Market's crashing. It could be down 4 or 5%, right? Those are pretty normal days over the last 30 years. It just feels so much more intense now that we're bombarded with headlines, constantly in our hands with our phones.
Yeah, so great points, Chris. And those headlines can certainly lead us in certain directions. But again, it comes back to the plan. Those of you that are already working with us, we've run those plans, and at all of our annual reviews, remember, we go back through, confirm, rerun those scenarios, make sure that you're on track. For those of you that don't have a plan or don't have a plan with us, I would encourage you to continue going through the meeting process, planning process with us, or to reach back out if we've disconnected. So I think it's paramount to have a plan in place. And as Chris said, there's going to be volatility. That's why diversification, having that plan in place, is so important, so that we're not having to worry about all of those headlines that we do here.
And I would say, following both Chris and James, is keep your emotions under check. Don't make emotional decisions. And, if you're a Star Trek fan like me, follow Spock's word of wisdom, which is be logical. And if you're logical about your decision, then you'll be on the right track.
And live long and prosper.
And live long and prosper. Absolutely. Can't do that though, quite. I don't know, James, can you do that?
There's an expert.
That was a great one.
Yeah.
So again, just one more thing before we hop off. So if you are a friend of or family or colleague of one of our clients and you're watching this and you don't have a plan in place, feel free to reach out to us and we'll be happy to go ahead and do a complimentary session and just see how on track you are. And clients, if you need to have a meeting with your team and you want to just make sure all the T's are crossed and all the I's are dotted, just so you can feel more confident, we're always here for you as well. So until next time.